I'm not approaching this from a political point of view. The Congress and the executive branch are supposed to be independent of the Fed. That's how it was set up in 1913 when the Fed was originating. Then when Biden came in, there was inflation. There were a lot of, this is one of these multivariate problems.
Yo, what is up, everybody? My name is Matt Drouin. I'm the host of the Go Big Live Real Estate Investors podcast. I am psyched on my mind today for a guest that doesn't fit the mold, our usual mold of a commercial real estate investor, but I brought on a statistician, a distinguished professor, consultant, researcher, and author with a wealth of experience that offers unique insights into the concept of chance and luck. He holds a BA in mathematics and a PhD in statistics from the University of California, Berkeley. And throughout his career, Dr. Michael Orkin has made significant contributions to the field of statistics, particularly in the gaming industry, where he frequently serves as a consultant. His extensive research has been published in numerous academic papers, and he has delivered invited talks on these topics, including a notable presentation at Google Tech Talks. Dr. Orkin is a professor emeritus of statistics at California State University, East Bay, and he currently serves on the mathematics faculty at Berkeley City College. His expertise and experience make him a leading authority on the statistical principles underlying games, chance, and the role of luck in various aspects of life. And the reason why I asked Dr. Orkin to come on our show today was because you guys out there that are going into uncharted territories when it comes to scaling up into commercial real estate investments, there's going to be this thing of probability, luck, skill, and how to really make sense of all those things. And this is going to be a really great show. We're going to dive into gamification of your journey and also talking about interest rates and the Federal Reserve, highlighting a chapter from Dr. Orkin's most recent book, which is the story of chance. What's luck got to do with it? There's a chapter on the conflict of interest rates I want to talk about, I'm curious about. So Dr. Orkin, thank you so much for being on the show.
My pleasure, Matt. I'm happy to be here.
Excellent. So first question, you're born, now you're here. What happened in between?
Okay. So I'm reminded of, I don't know if you remember Dayton Allen. He used to be a double talk guy. He was on various TV shows way back in the day. And he always would say, I'd like to begin my remarks by saying something. So I will begin my remarks by saying something. I grew up on the East Coast in the Washington, D.C. area. And while I was in school, that is in public school, through grammar school, through high school, it seemed like my strongest subject was math. Math and sports were my two favorite subjects. And I enjoyed reading. I had some great teachers. But when it came to going to college, I decided to pick a place that had a good math department. And UC Berkeley was fascinating to me back in those days. Lots of things were happening on the UC Berkeley campus. There was the various political things. The beatnik era was just ending. And I was in the DC area, so I decided to come out to Berkeley, where I'd never been before and where I didn't know anybody, and to start a new adventure. So I came to Cal, and I was sort of lost for the first year. It's a big place. And so I was, at that point, I sort of knew I had to be a math major because I would sink if I tried anything else other than just taking courses, which was fine because there was so much work involved. In math, I could handle any load that they gave me. So I became a math major. Then when I was a senior, I took a probability course. I hadn't taken any statistics courses to that point. I was just pure math major. I was planning to go. I had worked for IBM over the summers as a programmer, and I planned to just go back to IBM, who would have been happy to take me. And then I took this probability course when I was a senior at Cal, and I was sort of, I really enjoyed the topic, and the professor was extremely, a very good professor. He would challenge the class all the time. And so towards the end of the class, he asked me if I wanted to go to graduate school in the statistics department, which of course I didn't know anything about. And so I said, well, do I have to fill out a lot of forms? And he said, no, I'll take care of that. So that sort of sold me. And so I decided to go into the statistics department, which actually was broken into two parts at that time, people doing applied statistics and people studying probability and games and things like that. And that was the part that interested me. So I did it, and I was very excited by it. I had a great time in graduate school, met lots of really smart people, and my professors were really good. And so then after I graduated, got my PhD, I went to become a professor and published a few research papers. But my area of expertise was game theory and gaming in general. And so that um, at that time and since then, things have been really hopping in that field, particularly since the app phone technology and smartphone, let's call it, technology came out because there's so many games that you can play online. And there are situations where a consultant is needed. For example, um, in order to have wagering online, um, you need to show, in many states, not in all states, many states, you need to show that the game is a game of skill, not a game of chance, whatever that means. But there are both legal definitions and statistical definitions, and so it was my job in my consulting, which I'm still doing, to sort of blend those two things together to make the statistical definitions um, consistent with the legal definitions. And so I've done a lot of that, especially in the sports betting world. And so I also consulted for for the odds makers in Las Vegas for a number of years as part of that whole thing. But now um, I've also written a couple books, one on gambling, a couple on gambling games, a couple textbooks, and my most recent one, The Story of Chance, What's Luck Got to Do with It, is sort of has some stuff on gambling, risk taking, and other things like that. So here I am.
Excellent. Well, I'm glad you're here. So, I mean, the first topic I want to talk to you about is, there's statistics, and then how do you use statistics to create informed decision making, and relating it to we're real estate investors, right? So we're trying to identify markets, we're trying to identify asset classes within that market, and really taking historical data and trying to extrapolate it out into the future so that we're taking less risk. So there's that component of it. So what do you say, like, to that and parlaying statistics into like decision making?
Well, it's a challenge because one of the reasons is that people tend to misuse statistics in various ways. As people, we are just sort of hardwired to notice correlations and relationships between things. That's how we've survived. Back in prehistoric times, we survived because we were able to recognize when danger was nearby, and so today it's much more sophisticated. We can use data to try to make informed decisions, but often people notice correlations and they confuse that for being causation and they'll make the wrong decision. So, one of the challenges for me as statistician, when I'm teaching a class, when I'm writing a book, when I'm consulting, is to try to focus my clients or students on how to do stuff, how to manage risk, how to make statistical decisions without being fooled by correlations that may not be real, things like that. My thesis advisor, who was a very well-known game theorist, a guy named David Blackwell, passed away a number of years ago, um, was one of the things he was an expert at was reducing a complicated situation into a simple game. And he could do that with just you could be as complicated as you wanted to be, and he could change it into a simple game. And sometimes the answer that is your best strategy would just fall out because he simplified things. And so a typical investing situation, people are overloaded with variables and they have to identify the important ones. And so there are methods for doing that in software, but just intuitively, especially if you're doing something like real estate investing or playing the stock market as another example, you have to sort of have an intuition for it, and you have to know what are the important things and what aren't, and how not to be led down the wrong path.
So First of all, game theory. We hear it out there and we're supposed to pretend that we know what it means. So pretend I'm a dummy and I don't know what the hell game theory is. Explain it to me.
Okay, well, game theory is sort of a systematic way of making decisions in an environment where you have an opponent or opponents um, or situations where there's competition. So you can think of it as that way. It's some people will call it decision making. Now there are different kinds of games. There's zero sum games in which, like casino games, in which what you win, your opponent loses, and vice versa. So if I lose, if I'm betting in a craps game, the casino wins. That's it. Simple. There are other games that are called that are not zero sum games. Some of them are called cooperative games. There's a famous one, and people use this as an analogy when they're talking about things like real estate investment. There's a game called Prisoner's Dilemma, which is a game originated with prisoners, but it's a game where it's not a zero sum game, and this is more, it's very simple, which sort of falls into what my professor's strategy was, to try to make things simple. In fact, Einstein has this quote: "Keep things as simple as possible, but no simpler." And with Prisoner's Dilemma, there are just two moves. You can either be cooperative or nasty, and your opponent has the same two moves. They can be either cooperative or nasty. Different terms are used sometimes. Um, if you're both cooperative, you do very well. If you're both nasty, you do very poorly. If you're nasty and your opponent's cooperative, you double cross your opponent. That's what's called prisoner's dilemma. It's based on two prisoners in separate cells, and the police are trying to get a confession out of each of them by telling them, if you confess and rat on your partner there, you'll get a reduced sentence and your partner will go to prison. Otherwise, you're both going down the river. And so that's why it's called prisoner's dilemma, because the prisoner has this dilemma trying to figure out, well, should I rat on my opponent and get out of jail, or should I cooperate with my opponent secretly um, and just not confess, and therefore both my opponent and I will do okay. And so it turns out if you're just playing this game once, and so this works. So this works in many situations. In real estate, for example, you're competing with somebody. You want to buy the building. Someone else wants to buy the building, or you have a partnership with somebody and you want to make sure that everything is okay. But in the actual simple game called Prisoner's Dilemma, which has been around since the 1950s, it turns out that if you just play once, the best strategy is to double cross your opponent. Um, that's it. You'll get a better score than if you do anything than if you cooperate. But if you're playing for a while, so any situation where you have repeated interactions with the same person or the same company, then it's best to cooperate, because after a while, the both sides start to learn how to cooperate with each other, and they do better than if they're constantly have this cycle of revenge and um, backstabbing and stuff like that. So anyway, it's a very interesting game. It doesn't directly apply to investing in real estate or the stock market or anything else, but it gives some very nice, intuitive explanations that can be verified mathematically of how to behave in situations where you're dealing with not a zero sum situation, but where you have to deal with the same people over and over again.
Mm-hmm. Yeah, I mean, I think that I kind of use the two terms like abundance and scarcity. And to have the abundance mindset, you have to be cooperative, and even with your competitors. Actually, there was a really, really amazing story, which there was, I used to work for a development company, and for a client, we had 5 of these apartment assets that were for sale. Well, there was these 5 heavy hitters that were all across this region that wanted all 5 of them. And so one of the investors went to the other 4 and said, listen, we can kill each other, and then whoever wins this deal is going to overpay for it by it so much, just to, basically satisfy their ego, that you're going to end up losing anyways. Or what we can do is we can sit down, we can take these 5 properties and come up with a game as to who gets which one, right? And so they went, Greystone Apartments was the one that everybody wanted. So the one investor said, okay, who wants Greystone Apartments? And if they get it, they have to get the one deal that nobody wants. All right. And that's how they kind of started this actual thing there. And they carved up the properties to, I'm not sure if this violates Sherman antitrust law or anything like that, but that's how that deal went down and how those deals got distributed. They put on a collective offer together as a group. And that's how the transaction happened. So let's talk about, you mentioned that you had an advisor that was really good at reducing things or problems into games. You've probably run into this with clients you've worked with in the past. Can you give us an example or a case study of work that you did with a client where you took a complex problem that they were having and then reduced it down to a game in the process?
Yeah, well, so one example is I had a client who was developing a bunch of games. It was a client in India actually, and so their problem was they had too much data and they had too many overlapping games, and they didn't know where to start. And so one of my challenges, so they came to me with all this mound of data, and it was basically all in either spreadsheets or databases, which is great because that's what I want. But it was all sort of mushed together. And so the idea was, how do you? They basically just gave it to me and said, "Here you go. Show that these are games of skill." And so my main challenge was to actually separate these things and organize them. I used Excel in this particular case. And so I had to, things are in life, things are often intertwined. And so the big challenge was to separate them into separate parts, which were then easy to analyze for me. And I could even explain them to the client, which would have been impossible if I tried to put this into one huge situation. They wanted to open essentially an online casino, but not with the usual casino games, but with all kinds of different games mixed together. And so that's an example of how I tried to, and I was successful at it, by the way. I broke it down into about 15 separate games, and they redid how they were thinking about it in order to look at each game separately. And by the way, a quick comment: the example you gave about the real estate deal or the collaboration was a great example of Prisoner's Dilemma, the game that I was talking about, of how it's better to cooperate than to have everybody just competing, and then there'll be some winner, but everybody else will get screwed. And if you take that approach, at some point you're going to get the bad end of the deal. But it only works in situations where you have this possibility of cooperating over time. If you're just playing once and moving on, it doesn't matter.
Isn't that just a relationship?
Well, but what do you mean by a relationship? You mean any relationship between people?
Yeah, I think that functioning business relationships and specifically are associated with if because I used to be a very transactional person. I was the nasty in the Prisoner's Dilemma, and then I found that I was churning through clients. Churning through relationships very quickly. And I operate out of a small town called Rochester, New York. And I found that, damn, this thing really isn't working out too well for me. So I needed to learn about this thing called relationships and functional relationships, and understanding that I have to I have to stop doing that, and I have to, in order to have something where I can, do multiple transactions and deals with people that I want to do deals with, that I kind of have to take a different approach on it. And that's what I mean. Like it kind of sounds like a positive relationship on the highly functioning version or outcome of Prisoner's Dilemma.
Right, that's right. That's exactly right. It is. You could think of it that way, and that is exactly right. Now, and in a relationship, there's also the possibility of being nasty, and but one of the lessons of Prisoner's Dilemma, um, in some ways, it's just sort of almost a metaphor of things. But one of the direct lessons is that the cooperation part only works if you're doing it for an extended period. It's as if you're doing something with people that you'll be interacting with over and over again. Um, and some people aren't like that. They just do something and move on. Most people, though, have developed relationships. I'm talking about in the workforce, in their whatever their job is, um, and they. This is sort of like the story you were telling. Um, they have relationships that are ongoing and discover that they better learn how to cooperate or they'll do worse in the long run.
Mm-hmm. Absolutely. So I did want to talk about your chapter on the conflict of interest rates and the Fed, because us as real estate investors are always, it's like, Jerome Powell is a very, very important person in our life. So tell us about that chapter and kind of what you see going forward.
Okay, so first of all, I'm not approaching this from a political point of view, but so I'll say that as a disclaimer. But when Trump was president the first time, interest rates were very low. Trump repeatedly berated Powell, who came on. I think Trump appointed him initially, and but the Congress and the executive branch are supposed to be independent of the Fed. That's how it was set up in 1913 when the Fed was originating. Um, but Trump publicly berated Powell, and it worked in a sense because interest rates stayed down. Then when Biden came in, there was inflation. There were this is one of these multivariate problems. There were lots of um, things going on, including inflation, and Powell just started dramatically raising interest rates, much to a degree that we haven't seen in years. And one of the things he relied on, I mean Jerome Powell, the head of the Fed, was something called the Phillips curve. Now, the Phillips curve was used by economists for quite a while, but originated with I think a New Zealand guy named accountant named Phillips, who studied some data from the United Kingdom in the second half of the 19th century and discovered that there was a negative correlation between employment and inflation. Nothing about interest rates. There was a negative correlation between employment and inflation. In other words, or I should say, as employment went down, that is, let me put it in terms of unemployment. As unemployment went up, inflation went down. So that's the negative correlation part. And so was used to for decision making and policy making. But the Fed can't make unemployment go up directly. Jerome Powell cannot fire people from their jobs. However, what he can do, what the Fed can do, not just Jerome Powell, but what the Fed can do is raise interest rates. And so the theory was if you raise interest, so there's this other sort of theory, if you raise interest rates, then unemployment will go up. And when unemployment goes up by the Phillips curve, inflation will go down. So the Fed's job was to make inflation go down, and their approach was to try. And this was echoed in very loudly by Lawrence Summers, who was sort of the man behind the curtain when it comes to the Fed, in a sense, just metaphorically. But the idea was because of the Phillips curve, you could raise interest rates, unemployment will go up. That's not because of the Phillips curve. That's just because of what people thought would happen. And then when unemployment went up, inflation would go down. Now, unfortunately or fortunately, depending on how you look at it, none of those things happened. When interest rates were raised to the dismay or to the, yeah, I guess to the dismay of the Fed, unemployment didn't go up. Of course, a lot of people who would have been fired were happy. It didn't happen. Unemployment didn't go up. And not only that, the Phillips curve itself, if unemployment had gone up, it's not at all clear that inflation would have gone down because many studies have shown that the Phillips curve just doesn't work in our current climate. And one of the reasons for that is because correlation, so as a statistician, I can tell you that correlation does not mean causation. Just because things are correlated doesn't mean that one thing causes the other. And the example that I give, which has nothing to do with the Fed, but it's an important example, when the polio vaccine was first being developed back in the late 1950s, a researcher, this is when Salk and Sabin were developing their vaccines, a researcher noticed that there was a positive correlation between the polio virus and soft drink sales. And so this person got that in the press because it was a huge deal, especially among the people who, want to get rid of things like junk food. And the correlation was true. When soft drink sales go up, so does the incidence of the polio virus. And so it turns out soft drink sales had absolutely nothing to do with anything other than that there was a positive correlation because there was a background variable called the weather. And as the weather gets warm, both soft drink sales and polio incidents go up. So that's a story that illustrates what can happen if you start thinking that correlation means causation. And yet, economists, and even people like Jerome Powell, who, by the way, is not an economist, he's an investment broker, have been relying on as a causative model, and it simply hasn't worked. Now, inflation is a very complicated thing, and it's affected by lots of things. But one of the effects of raising interest rates, of course, as you well know, is that it completely changes the housing market. Because, for one thing, people who could afford to buy a house 3 years earlier can no longer afford to make mortgage payments. So if interests go up, you have a whole new game that you have to get involved in if you're in the real estate business. And if you own an apartment building, you have to worry rental rates go up too. You have to worry about vacancies. And so the Fed's strategy has been very much criticized, and Trump and a couple of senators have been making loud noises about interest rates need to come down. But the point is not so much what a particular politician wants, but that the whole basis or the mathematical or economic foundation for doing all this stuff has been something that's been discredited for years. Many economists, in fact, I'd say the majority of mainstream economists say that the Phillips curve is basically worthless. Now, the reason why I call the chapter in my book a conflict of interest rates is because Jerome Powell, and well, not Jerome, the Fed itself, led by Jerome Powell, but the Fed, which was founded in 1913, as I said, where does it get its money to survive? Well, it has certain securities, and the Fed survives based on the interest it gets from these securities. So, in a sense, it's a conflict of interest rates when they raise interest rates because they're getting more money directly in order to run the Fed. Um, but it's a very strange situation. Um, there are various people in various polar opposites in the political world, like Elizabeth Warren, the senator from Massachusetts, berated Powell in Congress a couple years ago about this very thing, about how could he possibly want to lay off 1 million workers just for possibly having inflation go down. And Powell agreed and just basically said, well, there'll be lots of pain. Now, of course, it didn't work, but now Elizabeth Warren was warning the Trump administration not to mess with the Fed, the direct opposite of what she did herself a couple of years ago. But anyway, it's a very interesting story. But for anyone who's involved in the real estate business, I would think that interest rates should not be sky high because it creates all kinds of problems.
Yeah, I mean, I've actually preferred the higher interest rate environment because we've had this widening bid ask spread between seller expectations as to what they want to get for their properties, and considering the interest rate environment being higher, we're having a higher annual debt service. And also, the other side of the token is the capital within which we raise from investors. The risk-free rate of return has increased significantly, so we have to pay significantly lower for the price of the properties, which the sellers aren't willing to do, or to become creative as a collaborator with a seller to synthesize an outcome that worked for both of us. And that's where creative financing and seller financing have come into play, where my clients are putting together deals where back 3 years ago, no seller would ever have done this. I've been having sellers take back a second mortgage at, like, let's say either 0% interest or and no payments in order to get a higher price, and then for the buyer, they get to blend their cost of capital down in the process. So I think that higher interest rate environment is definitely, there's deals happening there. But it's definitely, the Fed has done a good job of making the prospects of raising capital very, very difficult with the risk-free rate of return.
Right. So just quickly, so one thing I didn't mention was, of course, as interest rates go up, there are lots of ways to make more money, and that is, for example, just the most basic thing is a savings account. But there, as you point out, you can make deals that you couldn't make if interest rates were really low. Um, Another thing that isn't directly about real estate is that when interest rates go way up, it makes it harder for small business people to borrow, like restaurant owners who need to borrow money on a regular basis, especially post COVID. But yeah, there are benefits too.
Mm-hmm. Absolutely. So, I mean, I guess there's flaws in how the Fed operates and their dual mandate and that sort of thing. So, I mean, I guess, like, what's the new normal going forward? And also, it's like, I started in real estate in 2006, and I've been through a few different cycles, and there's always this thing of, like, okay, a soft landing, engineering a soft landing, and I'm just not sure. They were talking about that in 2006, and look where it got us. Although we had a completely different environment then. So, what do you say to that?
Well, a few weeks ago, Senator Mike Lee from Utah had an op-ed, had an X post which was labeled, had a hashtag in the Fed, and in it he suggested just getting rid of the Fed and having the executive branch either make those types of decisions, or the Fed still exists but has to report to the executive branch. Right now, the Fed is isolated from the executive branch. And this post was reposted by Elon Musk, who's now, the head of that Monty Python group, the, the Department of whatever it is of greater efficiency. And and Trump has been very consistent over the last 8 years of number one, not particularly liking the Fed. One of the reasons is that he's not allowed to tamper with it, and he likes to tamper with everything. But number two, just thinking that it's sort of structurally not set up right. It might have worked in 1913 when the Fed was originated, but now if the Fed starts making really stupid decisions, at least according to the executive branch, that is the president, or the Congress, then they should be able to get involved. And so, what do I think will happen? I think that the Fed is going to have. I don't know if they're going to get rid of the Fed. I doubt that will happen. But I think that the Congress will get more involved in at least saying things, and obviously the new president will, because he has done that repeatedly. If you just look at his what he said. And so anyway, what do I think will happen? I think interest rates will come down. That's in a nutshell. I think the Fed will remain the Fed. I think that when Powell's term expires in 2025, that Trump will appoint someone. I don't think he'll fire him. We can't really. But when his term expires 2025, I think Trump will appoint someone else. And it remains to be seen who that someone else will be. But I suspect it will be someone who will listen to Trump even behind the scenes.
So you talked about black swans in the past, and certainly, I mean, I would label the Great Financial Crisis as, a black swan event. So, this is always sort of like one of those things when everything is going kind of hunky dory, and then you get a black swan event that happens, and COVID could have been that. I guess how do you position yourself as an investor, and even a real estate investor specifically, on those types of events? And because if you're always prepared for it, then you're going to miss out on a tremendous amount of opportunities. So, what do you say to that?
Well, so first of all, the term black swan originated or was made popular by Nassim Taleb's book called The Black Swan, which came out in I guess late 1980s or something like that. And he talked about black swans as being these unlikely events that nobody anticipates and that have an impact on things. And for instance, the stock market crash. Now, one of the reasons for this happening, according to Taleb, is that people overuse things like the normal curve. They say, oh, this is a Six Sigma event or something like that, when in fact, the normal curve is, and that's based on the normal curve. And when in fact, the normal curve shouldn't even be the model that's used. And I have a couple examples in my book about that, of how the normal curve, that's the bell-shaped curve that everyone who's involved in anything quantitative knows about. And it turns out you can make bad decisions if you try to always use the normal curve, because in some cases it underestimates tail probabilities. And Taleb uses the term fat tails, which the normal curve doesn't have. And so these weird events are more likely to happen than people think they are. So I have a couple chapters about this concept in my book that are basically look at lottery. So, for example, the Mega Millions lottery. And I know that's a far cry from real estate investing, but it's about one of the basic concepts of chance, and that is in the Mega Millions lottery, your chance of winning the jackpot. And that's a multi-state lottery, so most people know what it is. Your chance of winning the jackpot is about 1 in 303 million. And it's weird because that's a very low probability. If you buy 50 tickets a week to the Mega Millions lottery, you'll win the jackpot on the average of once every 116,000 years. If you have to drive a mile every time you buy a lottery ticket, you'll have to drive an average of 633 round trips to the moon before you win the jackpot. So the question immediately arises, how come there are jackpot winners? And the answer is because so many tickets are sold. Well, that sounds kind of obvious, but most people don't understand the implications of that. Some statisticians call this the law of truly large numbers, which means given enough opportunity, any weird thing will happen just due to chance. Well, you can quantify that. Now, that's not always true. I can give you examples of lotteries where that doesn't happen, but that's something that people have to understand and appreciate. Namely, the normal curve isn't always the right thing to use, and whatever they're doing, they have to be aware that lots of other people are doing it. There are lots of opportunities, and if there are opportunities for people to do things a little bit shaky or flaky, then they'll probably happen. So you have to sort of be conscious of that in your management of your finances and investment strategies. My uh, my thesis advisor once wrote a mathematical paper called "It's Okay to Make Mistakes, but Don't Do Anything Really Stupid," and that was an actual mathematical result where he sort of distilled that idea into a game. But the point is that you have to have respect if you're involved in markets, and you have to use a strategy like the Kelly system strategy. And so you may have heard of that. It's sort of your basic money management strategy, which is called a fixed fraction strategy, which says that. Um, so one way to say it intuitively is the more you have, the more you bet, the less you have, the less you bet. Or you always bet a fixed fraction of your bankroll. Now, your bankroll doesn't have to be money in the bank, it can be real estate holdings. And you shouldn't bet at all. You should bet a fraction of what you've got, and that fraction depends. Um, the amount depends on how much you have, but a fixed fraction, the fraction always remains the same. So that's one type of money management strategy that's very popular. Very hard to figure out the mathematics, but if you just estimate them, then it's helped a lot of people, especially in hedge funds.
Mm-hmm.
Now, go ahead.
Yeah. So, Dr. Orkin, we're almost out of time. You've been very generous with it. I did want to get in my last question, and then I'll end the interrogation, and we can let our listeners learn about how they can learn more about you and the book and everything. So, at a very very high level framework perspective, because I know that you're not in commercial real estate, but we have listeners that are experienced real estate investors. They own a couple of investment properties. They want to scale up into doing larger commercial deals, and there's there's a certain amount of uncertainty in navigating new waters. From a standpoint of, am I doing the right deal? Am I talking to the right people that will be my potential investment partners? Am I even looking at the right market? So I guess what would be your words of advice on how they can be more lucky?
Well, I think I would use the term more skilled than more lucky. Um, but people, first of all, I think it's really important to be able to trust your partners. And I mean that may sound silly, but that's a very important thing if you're going to expand your business in particular. Then also to realize um, that weird things can happen, so you need to be, use, as I already said, a money management strategy. Um, and by money, that could mean properties. And also, um, let me give you an example. SBF, commonly known as, well, Sam Bankman Fried, commonly known as SBF, the crypto king. So this isn't really about real estate investment, but it's the same idea. I have a chapter in my book called The Crypto King Cons Himself. And what happened with Sam Bankman Fried, there are a couple of really good books out about him. And one of them is by a guy named Zeke Faux, Faux. He had many interviews with SBF before his whole thing collapsed, and he was a really smart guy. He went to MIT, has a degree in math and physics, and he knows about things like expected value. So expected value, or EV, is your average winnings. It's easy to compute for casino games, not so easy for investments. But EV means how you'll do on the average in repeated play. Positive EV means you can make a profit in repeated play. And SBF was excellent at identifying these types of situations in the crypto world. He made a big mistake, though, and that was he got overconfident. He would invest everything, even if there was positive EV. If you bet everything each time, just due to luck, you'll lose sometimes, and when you lose, you don't want to go broke because you bet everything. And so he made that mistake, and then started. Here's my next tip: he started borrowing money from his investors who didn't know that he was borrowing from them. And he had, as you probably know, he had two companies, and one was a hedge fund company, and the other was a crypto investment website. And so he went, and so every time you try to, so here's another little lesson: never bet big to cover your losses. You should always, if you lose, that's to be expected from time to time, but don't bet big to try to come out of it. Just always bet a fixed fraction or, fixed fraction of your wealth. So he did the opposite. He tried to double, he essentially doubled his money to try to make up for his losses, doubled his bets, I mean. And you saw what happened. You see what happened. He went broke, borrowed from his investors, which was illegal, and wound up in prison for 30 years. When he was a very smart guy, he just didn't know how to manage his money. Now, I've oversimplified stuff, but that would be along the lines of advice I would give.
Yeah, absolutely. Well, you've been generous with your time, Dr. Orkin. Where can our listeners learn more about your book and pick it up, and also get connected with you?
Okay, so my book, The Story of Chance, What's Luck Got to Do with It, is available on Amazon. It's available on Barnes & Noble and whatever other online retailers. Those are the two main ones. So you can get it there. I have an active LinkedIn page, so you can just go to LinkedIn and find me there. And you can message me on LinkedIn if you want more information. And so that's the main way to reach me. You can also just Google me and find out some of the things I've done, like my talk to my Google Tech Talk, stuff like that.
Absolutely. So we'll be sure to put that in the show notes. Dr. Orkin, thank you so much for coming on the show, and we'll look forward to being in touch soon.
Okay, Matt. Thanks a lot for having me.
Thank you.